Okay guys, hope you're well. We're going back to the Answers Hub. So let's roll the intro and we'll see what the question is. And a warm welcome to one and all. First time here, big fella Scruff, trying to put trading in the real world. And what I do for a group of guys I look after is I have an Answers Hub in the Discord. Basically, they ask a basic question and I'll come to camera and I'll answer it. Now, the Joe public mightn't get a lot of what we're talking about because a lot of what I do is hidden behind closed doors inside the squad for obvious reasons. So I do apologize if you don't grasp what I'm talking on, but the guys in the squad will know exactly what it is. Sorry. So let's get into this. Yes, Perry, it was your fault. You goaded me into booking a holiday. And yes, I am going on holiday again next week. Oh, I hear you cry. He's going on holiday again. That's every month this year. Damn right. Should be twice a month. But there you go. Anyway, Answers Hub. Stephen C. Salute to you. If you look in the way of the Scruff, you'll see there's a module dedicated to the river. Now, the question here is monitoring the major pairs for the river, correct? The river will work on any product no matter what because it's based on a trend. So it doesn't matter whether it's gold, pork bellies, or a major Forex. So the amount of products you look at isn't really the issue. Looking at it on a daily time frame, and the prop challenge has a drawdown of 5,000, so that's 0.5 lots. Yeah, near enough. So your calculations are quite correct there. There is a formula. It's £1 for every 1,000 of liquid money. In the prop industry, you use the drawdown as liquid money. Anybody talks about the size of their account, pay very little attention to it because the drawdown is the account. The rest of it is just buying power. Now, when he goes to place his stop on a daily, it could be 300 plus pips away. Not sure what market that is, but you are right. The positions can be huge. But the position size would then come down to 0.2, 20p. Yeah. And it isn't worth risking anymore. So I'm glad you're thinking along them lines of preparing yourself for what can go wrong. The 4 hour is a bit better. And the 1 hour is 20. The triggers aren't frequent, correct. And my risk gets inverted, wrong. Right, that's the bit that I picked up on, wrong. It doesn't matter whether you're going to market with the river, golden eye, push, your own strategy, whatever it may be. Your risk reward, if we're going down that route. Now, I don't subscribe to risk reward. Just so you can get that off the bat. I subscribe to return on investment. I think the moment you risk something, you've lost it. So it's the wrong terminology. But you've got to kind of figure out whether the trade is worth taking. If you've got a stop that theoretically is 200 and sort of 90 pips, 300 plus pips away, your target needs to be equal that on the other side. So you're always at a point of 50-50. It's either 50% going to go for you or 50% going to go against you. If it's inverted and you're looking at a swing trade, which predominantly a river trade is, you're going to get carted out and you're going to get caught more often than not. You can do inverse sort of loss towards a win if you're scalping because you've got no other choice. You know, it's small, nicks of the market out, and you just got to kind of roll with the punches when something goes wrong. But if you kind of work on a 50-50 basis, right, okay, my stop is there. Now in the river, it's defined for you. It's the other side of the river, or you can put it halfway into the river where the moving average is. They are two distinct stop areas. You then look to where a structure point is above it based on the distance of your entry to the stop. So you just put a measuring tool on See how far it is down, and then put the measuring tool on roughly where you're going to get in, and see if there is a target criteria around it. Now that can be a level, it can be the top of a swing point, it can be top of a Bollinger Band, it can be top of a moving average, say a 200 moving average, anything like that. But you want a reason as to why the price will move there. If they're one-on-one, all right, fine, go for it. If you look at the market, and just because you can put £5 into it, doesn't mean to say you have to. What you can do is ask yourself a simple question. Can I afford it? So if you look at this, it's 100 pips, and then you're putting a fiver in, well, it's going to cost you 500 quid. You go, don't fancy paying 500 quid. It's a lot of money. Too much. So half it, but leave the stop where it is. Oh, talking of things that stop, what have you stopped paying for? How dare you?
I'm going to go get some bread and have a break.
You're going to get some bread and have a break?
It's all over the place. I've got it all over the floor.
You've got it all over your arse.
That's it. It's all over the floor everywhere.
And before, and what have I done for you today? I've been building today. I made her a washer. I've done the plumbing in the kitchen for the new kitchen that's fitted. So don't think I sit here doing now. Because, correct?
I never said you did.
No, but the audience might, and you will. You'll milk it. And do you know what she's made me do? Yes, it was her that made me buy another holiday. So, sorry about that.
Would you like anything?
Well, I can say yes, but not on the camera. All right, catch you in a bit. Lost my thread there. One thing you need to remember about these videos is they're all live. I script none of them. You ask a question, I come straight to camera, I'll answer it, and I get to it as quickly as I possibly can. Case in point, this was asked at 2 o'clock, it's now 3. Seeing what's going on, come to camera, just because they need to know what it is. Right, so what was I saying? 50-50. Ask your question, can I afford it? If the answer is no, I don't want to pay 500 quid, then you have to either not trade or reduce it. So if you half the position, well, now cost you 250 quid. Do you want to pay 250? No. Half it again. Well, it's 125 now. Can you do 125 on 5 grand? Yeah, not bad. Then that's your starting point. That's your position size. Half, half, half till you're happy with the monetary amount. Then when you go to market, you're calm because you've agreed to the price. Now, these are things that are in the earlier modules of Where the Scruff, and the things that nobody ever talks about really, because you always talk about, get the big money, show me the money. No, show me the docs, I don't want to talk to you. Psychology is a big thing in trading. And if you're looking at big stops, it's going to naturally frighten you. So the only way you can stop that is reduce the exposure. You pull the stop in tighter thinking you're saving money. You're not. What you're doing is you're pulling the stop in line with the freight train. And trust me, if you can stop a freight train, good luck. But I think it'll rip your arm off. And that's it. And then if you're still unhappy, just don't take the trade. If you've got all of the products in the world to look at, you'll find 2 or 3 opportunities, certainly every week. And then on a swing trade, it's going to last for 2 or 3 days. You only need one. So if you've got to wait till Thursday, get your trade, fine. Pay you just as much as doing Monday, Tuesday, Wednesday. Hope that helps.
No way!
Anyway, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.